Hi, my name is Lisa Cummings, and today I'm going to share with you some information regarding cash balance plans. Specifically, what are some of the frequently asked questions that owners may have when they are contemplating whether our cash balance plan may be a fit for their particular organization? First, I'd like to share with you a little bit of information about our law firm. Our law firm is Cummings and Cummings Law. Our firm website is www.cummings.law. Cummings and Cummings Law is truly a full-service law practice. We assist business owners, executives, real estate developers, and their families. And in our particular firm, we also have the ability to assist business owners in conceiving, planning, growing, and even exiting their particular ventures. We assist individuals in wealth preservation as well as estate tax planning. A little bit about myself. My name is Lisa Cummings, and I have throughout my career worked with large organizations, assisting them in designing and implementing large, compliant, competitive retirement programs, as well as competitive health and welfare plans, compensation program design, and even assisting executives through executive compensation planning and supporting their boards throughout many Fortune 500 companies. Without further ado, I wanted to share with you a bit about what we're going to be discussing today. First, a bit of a refresher on how a cash balance plan works and how it can enhance your existing 401k plan, and then some frequently asked questions about cash balance plans. As a refresher, some quick definitions as it comes to our particular retirement plans we're discussing today. A 401k plan is a defined contribution plan where employees can set aside contributions out of their pay on a pre-tax basis or an after-tax basis, and then the employer can add matching contributions or profit-sharing contributions on top of that. The participant's retirement outcome depends upon how much they contribute, how much the employer contributes, and then the investment performance, which is selected and guided by the participant themselves. Contrast that with a cash balance plan, which is a defined benefit plan or a pension style plan. That cash balance plan is actually presented in an account like format, and each participant has a hypothetical account balance. Each year, that hypothetical account balance receives a pay credit, which is a contribution by the employer for each of the covered employees for a percentage of their compensation or a flat dollar amount, plus an investment or an interest credit, which is a stated rate that is defined by the plan itself. Cash balance plan is typically funded primarily by the employer and requires each year an actuarial calculation and funding analysis. If you remember one thing from this video today, remember the 401k plan is a flexible, familiar retirement plan platform, whereas the cash balance plan is the pension engine that can allow typically larger deductible contributions by the employer when the cash balance plan will fit for that particular organization. As a simple illustrative tax example, then comparing how a 401k plan only over here in the blue column will allow a deferral of a maximum of $80,000 annually if the participant in this plan is an employer who is age 50 or older who can maximize on the catch-up contributions in the 401k plan, plus the employer maximizes the maximum amount the employer can contribute to the plan. In this example, IRS law will set the limits on a 401k plan on an annual basis. Here, this example will allow only $80,000 for employee and employer both to set aside for retirement for this particular participant. Contrast that with this green bar chart over here to the right, which would include the $80,000 from a maximized 401k plan, plus an additional $200,000, which could potentially be contributed by the employer for this 50-year-old individual. Actual circumstances of the company as well as employee census information, how staff is paid compared to how the owners are paid, the difference among their overall compensation, their ages, will actually determine how much that 50-year-old will be able to have placed in a retirement account for them. To estimate the tax impact, you could see the additional $200,000 that could be contributed by the company into that cash balance plan in this particular example. If there was a marginal tax rate of, say, 37%, then there could be an additional tax savings of $74,000 for this one person alone. Moving forward with some frequently asked questions that I receive from owners who are contemplating adoption of a cash balance plan. So one of the first questions they ask is, well, do I just do a cash balance plan instead of my 401k plan? The answer is no. Most employers choose to keep the 401k plan as the core savings plan and then add a cash balance plan as an additional layer. Another frequently asked question is, who funds the cash balance plan? The employer funds the cash balance plan. Participants each year will receive a pay credit, which may be a percentage of their pay or a flat dollar amount, and interest credits as well on a hypothetical account balance. Another frequently asked question is, who bears the investment risk? The employer bears the investment risk for delivering the promised credits for a cash balance plan. The investment risk is defined up front when the employer establishes the cash balance plan. So it will become a definition that the employer will select if they choose to adopt a cash balance plan. The employer can define a reasonable investment return to be equal to a benchmark rate of return over a period of years. Another frequently asked question is, can the amount of the contributions be changed each year? And the answer to that is no. A cash balance plan is much less flexible than a 401k plan. Cash balance plans have to follow IRS regulations as well. And an IRS regulation will require that that cash balance plan be actuarially funded every single year. That's why it's important to understand up front if your particular organization is a good fit for a cash balance plan. More on that in a moment. Cash balance plans often require ongoing annual funding within a range established by the actuary and as required by the Internal Revenue Service. Another frequently asked question is, do all employees have to be included? And the answer is yes. This is an IRS qualified retirement plan. The IRS ensures that all employees who are eligible are covered by that plan. However, plan design and communication can help manage cost and expectations of the employees. Staff employees who fit within a certain demographic could be awarded a flat amount or a flat percentage of their compensation annually, while owners could have a larger amount contributed on their behalf. All of this depended upon compliance with IRS funding guidelines as well as the actuarial calculations. Some practical next steps to determine if a cash balance plan is a right approach for your company. First, confirm if your 401k plan is optimized and compliant, and then run a 3 to 5 year feasibility study using your employee census and your contribution goals. Then review the total employer cost, just not the owner number itself. Now, I will tell you, our firm is uniquely capable of assisting you in ensuring your 401k plan is optimized and compliant, and we can also assist you in running a 3 to 5 year feasibility study utilizing your employee census and contribution goals. Then we could work with an actuarial firm to ensure that the exact employer cost over a multi-year period of time would be known for yourself, for all of the employees, as well as for the owner specifically. If you would like to ask any additional questions, feel free to send me an email to my email address. My email address is lisa@cummings.law. Thank you very much for joining us today.